All right, Accounting 2, welcome to 6.1, where we'll be talking about the direct write-off method of recording our uncollectible accounts. So we know that many business transactions happen for cash, but just as many business transactions are also completed on account rather than by paying for cash. And on account, of course, means that people owe us money. A few reasons why businesses like to offer on account transactions for credit terms include the ability to attract new customers, increase sales to their current customers, and also try to encourage customer loyalty with their company. Of course, before selling on account as a business, we should make sure to investigate all of our potential credit customers' credit history and their ratings to ensure that they will be customers who pay promptly. Now, regardless of the amount of time that we spend trying to screen our customers, we still have some that are not going to pay when their payment is due. And so we refer to that, those accounts receivable, as uncollectible accounts. So when people owe us money, of course, we classify that still as an asset, but we put it in accounts receivable, and when we deem that they cannot be collected, we call it uncollectible accounts. Sometimes they're referred to as bad debts, but more often than not, we hear them referred to as uncollectible accounts. Now, at the time when a customer account is believed to be uncollectible, we need to make sure that we remove it from our company's books. And the uncollectible account should be canceled and removed from the asset portion of our business because it no longer is going to be in accounts receivable. It needs to be removed from the asset section. So we call that writing off an account. It means canceling the balance of our customer account because we determine that the customer is not going to pay. So there is always a chance, though, that when you do write off an account, that it might be collected eventually. So when that does happen, we need to make sure that we restore the account balance to that accounts receivable account, and then we can record the receipt of cash. If we don't do that first part, then it would look like the customer overpaid, and they did not, because their account was previously written off. So we have to put the balance back into accounts receivable, and then we can take it out with the receipt of cash. So it just says that an amount owed by a specific customer is part of the accounts receivable account balance until it is paid or it is written off. And then once it becomes uncollectible, we need to transfer that amount from an asset into an uncollectible accounts expense, which of course is an expense of doing business, and that account is held in our general ledger. Now, if a company is small enough and has very few accounts that they or customers that they allow to pay on account, they may choose to use a method called the direct write-off method when it comes to writing off their uncollectible accounts. So all that means is that they record uncollectible accounts expense only when an amount is actually known to be uncollectible. So let's say, for example, our business accepts credit terms from Fleet Farm, okay? And Fleet Farm goes 90 days, which is 3 months, without paying us. At that point, we would say, we don't think we're going to receive that money from Fleet Farm. And so we write off whatever they are said to owe us. So it's only when we know for sure that they're going to be uncollectible that we write it off. Now, in our next section, we'll talk about the allowance method, but for now, we're talking about the direct write-off method. So here you can see it says on November 4th, we wrote off Plaza Electronics account as uncollectible for $182. Memorandum number 62. So when you write off an account, it does go in our general journal. And so we have a debit for uncollectible accounts expense for the 182, and then the credit actually goes two places. Remember, it goes to accounts receivable because it needs to come out of there, but it also needs to come out of our customer account, which is Plaza Electronics. So that's why we have the dash there. That 182 credit is going two places, and you can see that over here. Now, if it happens that Plaza Electronics decides to pay us, maybe we don't know, the transaction doesn't say when it happens, but maybe a month later we receive a check from Plaza Electronics for their previously written off account. All we do is we flip that transaction to reopen or put back in the amount that they owed us into our accounts receivable. So that's what's happening here on the 6th. It says we have our accounts receivable and Plaza that gets debited, and then uncollectible accounts gets credited. So I'm just going to flip back here real quick. You can see that this was our transaction to write off the account, and then this is the transaction to reopen the account. So we have to do this first, otherwise it would look like we Plaza overpaid and they would have end up having a credit balance in their account, and that would never happen. And so first we record the reopening, which is part one here, and then part two we want to record the receipt of cash. And so when you have a cash receipt, it goes in the cash receipts journal. So this would just be like they were paying us any other time we receive a payment on an account. So the accounts receivable credit is 182, and of course that's also going to go to the customer account for Plaza, and then cash gets debited. So that is that, and we will head over to our 6-1 and do our work together.